Welcome back, everybody, to the Investors Roundtable. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And I don't even know where to start right now because this is one of those episodes that might go 3-4 hours right now. But we have so much to talk about today. I think we can probably all agree that this is one of those events happening in financial news in the markets that could potentially have a lot of repercussions down the road, and we're here to talk about them all today. I mean, the original topic was just the gamification of the stock market, but I think at this point we can all agree that if this was monopoly, the board's been taken away. But with that, I'd like to introduce everybody that's joining us today, and then we'll jump right in. So first off, we got Tom Bachrach. Tom, welcome back. What's going on?
Not much. Thank you for having me back. Tom Bachrach, PFH Capital here.
Good. Very good. Stephen Kiel from Arquitos Capital. What's up, Stephen?
It's good to see you. Been a few weeks. What are we asking? Where you can find me? Arquitos.com. Looking forward to this.
Nice. And we got Yaron Naymark from One Main Capital. What up, Yaron?
How you doing, guys?
Right. We also got Gary Ribe, the host of In the Market Trenches podcast. He's getting ready for all the upcoming episodes that we got going on. So, Gary, what's going on?
I am feverishly working on them.
That's right. That's right. And finally, we have the inimitable, the man himself. He's got almost 1,000 followers. Well, I mean, he's a couple hundred away, but he's close. We got Kevin Shea from @TheGoodPrick on Twitter. What's up, Kevin?
Just eating my popcorn.
Just eating your popcorn. That's
watching
right.
the show.
That's right. I mean, all right. So honestly, I don't even know really where to start. I mean, should we probably, I think we should probably give everybody a little background, not that, and we'll do it in the simplest way possible and then go from there. So who wants to take the stab at being able to, as simply as possible, describe what has happened over the last week or two here with Robinhood, GameStop, AMC, all full disclosure, not a shareholder in any of these. So
I'll try to give it a go. We'll see if I can do it justice. And by the way, this is all speculation on everyone's part because no one really knows the whole picture. So it's a puzzle that people are still trying to solve. But basically, it seems like over the last, it's accelerated over the last few weeks, but it seems like over the last, call it year or two, I guess really during COVID, it really accelerated when people were at home and started the gamifications of markets really began. It became really easy to trade stocks and options. And obviously people are drawn to lower priced stocks. So they think a $1 stock is cheaper than a $100 stock, irrespective of how many shares are outstanding of a company or how much revenue or profitability. It just seems more affordable to people. And on a similar note, options tend to be lower priced than buying a security outright because you get leverage. And the way you get leverage with options is that, let's say you want to buy $100 notional of something, so $100 worth of value. By going out and buying options, you can structure the options in a way such that your down payment on that $100 purchase could be $5, it could be $10, it could be $20. And basically it's pick your own poison. You pick how far out you want to go in terms of duration and how far out of the money you want to go in terms of your strike price. And so people have gravitated towards shorter expirations and further out of the money options because that's where you put the least amount of money to get the highest notional exposure. It seems like it's good bang for your buck. Now, the counterparties who are selling those options are called market makers. Those market makers, they don't naked sell those options. They go out and hedge those options with stocks. So for example, if you want to buy $100 worth of notional worth of stock and you're putting down, call it $5, they're going out and potentially buying. If the option is really closer to being in the money or actually deep in the money, the counterparty has to go out and buy that amount of stock that you're not putting as your down payment. So it's kind of, think of them as like a mortgage lender of sorts that goes out, you put your down payment down as the premium, they go and give the mortgage and help you buy the security. And so as a stock price gets closer and closer to being in the money, the more stock the counterparty has to buy just to stay hedged on their position, because they sold you an option that was far out of the money, for example, which means the odds of it being in the money were low, so they didn't need to buy that much stock. Then if the stock goes up, they need to buy more and more and more over time. So people, when the market started to become gamified, they were buying these really low priced options that gave you huge notional exposure with very little down payment. And the market makers didn't go out and buy that much of the stock because the odds of those options being in the money at some point in the future were very low. And as the stock market has risen, those options become more and more likely to be in the money, and the counterparties have to go out and buy more and more stock. And as that's happened, those options have gone up a lot in value. So more and more people have started to buy low price options that are even further out of the money with short duration. And as stocks kept going up, market makers keep having to chase it higher and higher and higher. And so it's become this self-fulfilling prophecy where like people on Reddit and Wall Street Bets have figured out if they all just keep buying these super out of the money options and they drive the stock price up a little bit, even a tiny bit, the market makers at that point have to buy more to hedge their position, and the stock goes higher. And when the stock goes higher, they have to buy even more to hedge their position even further. And so it's created this self-fulfilling prophecy. And then they figured out an even better cheat code. If you do that with highly shorted stocks, not only do the market makers have to go out and delta hedge their position by buying the stock, but people who are short the stock now have to start covering because their position is becoming too large. And so they've really figured out, I mean, there was a glitch in the matrix, there was a cheat code. They figured out how to use it. You know, their intentions were to make money. I don't think their intentions were anything other than make money, but like, it sounds funny to say stick it to the man and form this whole narrative around it. And now there's this whole outrage about whether what they're doing is collusion and whether it's fair or not fair. I think there's multiple sides to that point. I hear people saying it's fair. I hear people saying it's not fair. My personal belief is that it's not necessarily 100% fair, but it's also no different than what institutions have been doing for a very long time, especially quant funds and the like, who take advantage of behavior and information on a non-fundamental basis to scalp money from people. And so it is what it is. I don't really have a strong point of view on whether what they're doing is right or wrong or whether rules should be changed. But the reality is that it led to some funds almost blowing up over the last week or so. The reason being that there are funds that run highly leveraged. You know, there are funds that run 150, 200, 250, 300, 350, 400% long. And then they balance that with short. So if you're running 4x long and 3x short or 3.5x short, you think your exposure to the market might be low, but all of a sudden you have 750% of your capital at risk. And if those things move against you 10%, that's how you lose 75% of your fund in a very short period of time. So it's kind of been a perfect storm of chaos. I feel bad for these fund managers a little bit because like, it kind of, you know, never in a million years would they have imagined, you know, a diversified portfolio of hundreds of positions all move 10% against them in the same week at the same time, both the long and the shorts. And it's like, kind of like a perfect storm, but it is what it is. I mean, risk management 101 says, don't put yourself in a position of ruin because it's very hard to come back from a 90% or 100% drawdown. So I think these people are sophisticated investors. It sucks to be in their situation. I feel bad, you know, for the stress that they're going through and that their LPs are going through for having lost money. But, you know, it's another lesson for everyone to learn and walk away with hopefully a lesson that they don't repeat themselves.
Got it. All right. So that was a great start to kind of paint the picture of what's happening. So I want to zone in on firstly, you know, what Yaron pointed out as it being as investors, whether they're new or not, but investors finding this glitch in the matrix. You know, how did this happen? You know, what is it the fact that because there was more access and it was now, you know, with Robinhood, it's free to create an account, free to trade. Now, because they have access to the chessboard, now it's like, all right, well, what are some of the different moves that I can do to now win? Is that how this glitch was found? Who wants to jump in on that?
So I'll jump in a little bit on that, and I'll say that I agree with everything that Yaron said, and just sort of, I will say that if you read through the Massachusetts Attorney General's complaint against Robinhood, what you learn is that a bunch of people got approved for options accounts that otherwise maybe should not have been approved. It was one of the things, and so you have this democratized access for people. Are these people sophisticated, not sophisticated? I think it probably runs the gamut. But sort of, they figured out at some point that they can weaponize these call options against certain targets. And are the targets all that sympathetic? I don't know. I mean, they're big boys that made a big boy trade, run big boy funds, and do very sophisticated things. So, but at a certain point, I wonder, those people who are on, Reddit, Wall Street Bets, individual investor types, at a certain point, they got some bankroll from doing it and became even more powerful, and then started looking for other targets that they can do it in bigger size. But I don't necessarily know that all of the activity in these different things are them and them alone, because I think you might be able to make the case that some of these other sophisticated funds out there saw a whale in trouble, and they didn't put the carving knives away. They've got them out and sharpened them. And so I think that they kickstarted something for sure, but a lot of the dollar volume flowing through these names, it couldn't possibly be all retail people. It has to be somebody, they saw somebody in a vulnerable position and they just hit the accelerator, took them out.
I think Gary's writing an episode of Billions right now. I think that's really what's happening.
So
I mean, it's tough to make the case. It's tough to make the case, though, that anyone's gunning for anyone, right? It's a free market, and everyone is trying to make money for themselves and for their investors. And if you know that someone is going to be a forced seller or something, the price is going down. So even if you don't want to hurt them, the price is going down. And if you think it's an asymmetric bet to be making, is that something wrong for you to be doing? And do you think that if you were in that vulnerable position and they knew they could make money, they wouldn't do the same to you? I mean, I think they would. And I think, I don't think it's anyone out to get anyone. I just think it's everyone trying to make money for themselves. And I
don't mean to imply that it was a personal thing by any stretch of the imagination.
Yeah,
I think they saw the setup for the trade and was like, this is a really good setup for a trade. Basically, they're engineering a corner in the stock, right?
Yeah, well, it's partially that, and partially, I do think once you hear of other, 5 other big funds blowing up, you're like, oh, wow, that means other funds might be in trouble. Maybe everyone's going to de-risk. That means everyone's going to sell their longs and cover their shorts. So I should sell my longs and cover my shorts before they do, because we're in a lot of the same situations. And if they're selling all their longs, they could be down 5 to 10%. So it could be a little bit self-preservation. It could be a little bit profit seeking. The reality is you put yourself in a vulnerable position that the market could sniff out, and people will try to capitalize on it, not because they want to hurt you, but because that's how markets tend to work.
I think this whole thing is thought of as being some sort of grassroots organization by individual retailers that collaborated together, found some way of doing these manipulations of the market. My attitude is that I think you're right. It's got to be some sort of organized general approach with somebody very, very smart, people or whatever, saw the opportunity, saw the algorithm to be able to play it out, saw the means of being able to do it, and had this capacity for being able to call in the troops, if you would, to execute the plan. I think that I don't think this just happened. I think it was a well-planned activity by a well-informed and highly intelligent group of people. I mean, I don't see how this could actually happen just from a grassroots perspective.
Look, I think other than value, the value factor, momentum is one of the most proven factors in all of history. I mean, decades and momentum is a thing. People see prices going up and they want to get involved, and people see prices going down and they want to sell, and that creates opportunities for fundamental investors a lot of the times. The momentum, I think this became obvious in hindsight. Obviously, I didn't capitalize on it. Otherwise, I would be sitting here with a $50 million GameStop position that I started with $50,000 in. But like, I think in hindsight, this became obvious. For me, when I think back on it, it's really Tesla is what made it obvious. Tesla is this very high priced stock, that's very hard for people to buy a lot of shares of because it has a high sticker price in terms of just per share value. And so I think people really believed in Elon and changing the world, electrification of cars, and they started buying out of the money call options on Tesla. And all of a sudden, over like a year, 2-year period, Tesla literally would not go down because people just kept buying more and more out of the money call options. And every time it went down a little bit, people bought more and more, and they were buying the dream. They weren't buying the valuation of the company. They were buying the dream. And by buying the dream, they actually impacted the stock price in a way that it becomes obvious that if masses just keep buying out of the money call options on names, it works out really well for the stock prices. So I don't think this was super planned out. I think they learned it by accident. They realized that when a company has a lot of momentum and it has a highly liquid options market, and you realize that a lot more activity in those options are happening out of the money in high volume, and the stock starts to work, everyone looks at that momentum, and I think they want to jump on the bandwagon because momentum is a proven trade. And then all of a sudden they realize that there are some of these that are happening on highly shorted stocks. And yeah, there's a forum now so they could all exchange ideas, and the best ideas on Reddit move to the top because they get upvoted and comments and stuff. And so like, that's how you have 2 million people all of a sudden deciding to do the same thing. And they found the glitch in the matrix. But like, I don't know that it was, maybe it'll come out that there are some sophisticated players that, went behind the scenes and planted bots to try to get GameStop to run up the Reddit message boards. I personally doubt it. I wouldn't be shocked. I'm not saying it's impossible, but I just think like they figured out this trick and the stars aligned and they went all in and it worked for them. And hopefully they know how to cash out some of their profits and leave some, on the side for the government, and then go buy themselves something nice and, not have to worry about money ever again.
That's a key point too. Are they understanding how much the government's going to take of that? So, look, I think, I don't know whether it's a coordinated attack or not. Maybe we'll figure that out. There'll be something written. Michael Lewis will write something in a year or two about it. But, the point is, though, even if it was partially coordinated or fully or not, it's an interesting development here that now there's a risk shown. It is very obvious to funds that short, and that's going to fundamentally change the way that they operate going forward in their risk guidelines, and it will fundamentally change how the market works, which is interesting because a lot of the investment here on the long side is made possible because of specific bets on the short side, and there might be some ramifications here in the next 6 months to the market as a whole.
That I agree with you entirely on. I think that the idea of shorting is going to give people so exposed to the repeat of the same situation that they're going to be very, very afraid of being able to take very big short positions. And it will ultimately, as you said, I agree, it'll ultimately change the dynamic of the market. And I see that coming. And the same thing is true as the issue I'm looking at is how many of these shorts, maybe your own knows, how many of these shorts are actually naked, and whether or not the part of naked shorts has even a more impact on the whole situation.
Yeah.
I'm unfamiliar with, I'm only asking the question.
You mean where they don't borrow the shares?
Right.
Yeah, I don't know if that's legal. Is that legal?
I thought it was.
I'm not sure.
It's legal. I'm pretty sure.
I don't think it is.
Yeah, I don't think it's legal.
I thought it was semi-legal.
Sorry?
I thought it was semi-legal.
Oh, maybe it's semi-legal. I don't know. I thought it's not legal, but I do think that, look, I don't think these people started out with massive short positions in GameStop. I think what happened is they started out with a 2% short position in GameStop, and GameStop went down 50%, and they topped it back up to 2%, and then it went down another 50%, and they topped it back up to 2%. And they made a lot of money shorting it all the way down. They never covered any of their stocks. This is my guess. I have no idea. They made a lot of money shorting it all the way down. They had this big unrealized profit in these names. And now it's a small notional position for their fund. And then I think when it starts moving against you, it gets bigger, obviously, and you're not taking off everything you put on. So you started with, shorting 100 shares, it got cut in half. So now you shorted another 100 shares. So now you're short 200. Then it got cut in half. You shorted another 200 shares. So now you're short 400. So you started with 100. Now you're short 400, and it starts moving against you. And I think you're like, I'm not covering it. It's just moving slightly against me. But like the same way you doubled your position on the way down, you should, in theory, from a risk management perspective, be having your position on the way back up. And I just think they probably didn't want to take the mark. And they're like, this is stupid. They're going to run out of money, these call option buyers. And eventually, when the options expire, this stock is coming right back down to earth, and it moves against you and against you. And next thing you know, like I said, if you're levered 500% or 750% or 400% and things move against you 10% on your whole portfolio, you're down 40, 50%. And let's just say you're only down 15, right? Not 40 or 50, not existential risk yet, 15 to start the year. You know that like if you wait it out a lot of times out of 10, I'm not going to say 9 times out of 10, but a lot of times out of 10, things will revert back to the mean and you will get back to flat on the year. And you also know that if you de-risk when you're down 15 and things do revert to the mean, your LPs are going to be like, what the hell were you thinking taking things off when they move that far against you? Like, do you not believe in your own thesis and your fundamental research and your conviction? Like, and so they're kind of in a tough spot. It's either lock in the losses and then have to answer tough questions to their LPs if things revert back, or de-risk, but like, yeah, you're locking in the losses. And I think you genuinely think like it's probably going to revert back. And at that point, they weren't an existential, like we have to manage to our LPs investments or our own investments, but a lot of them are heavily invested in their own funds. You're just thinking, I think this is going to revert back. But like in hindsight, it's probably going to haunt them for the rest of their careers. They're going to think, man, like if I went on a run and was just clear-minded when I was down 15% on the year, like I've been down 15 before, I've clawed my way back, I've put up 50% years, like I could claw my way out of down 15. How did I not just think like save the business, make sure I don't blow myself up and de-risk and de-lever? I mean, I kind of think about some of these. I mean, I've done some things in my life, not in investing that I think this way about, but like where I'm like, man, if I had just been a little more clear-headed for that like 5 or 10 minute period, I would have done things completely different, and like imagine it being your business or your career that you spent decades building, and your reputation and your LP's capital and institution that believed in you, and now you lost them hundreds of millions, if not billions of dollars. I understand the Reddit people are like, they're the suits, they've taken advantage of people, they're sitting on their yachts and like, screw them. I get that. But like from a human element, I just kind of feel bad for them personally also.
I love it's one of my favorite things in this whole thing has been like the David versus Goliath, like dumb narrative that's come out where somehow the shorts are Goliath. I guess like no one's been paying attention the last 3-4 years, but I mean, I'm pretty sure they just put like last year, they finally put short sellers on like the endangered species list, so you get all these Redditors that are like celebrating like the fact that they just flew over to Namibia and shot a couple rhinos and dehorned them or something. You're like sitting here going you do realize that short sellers like isn't like the quote unquote Wall Street, it's like, I think, and that's just a narrative that's come out. But it's kind of crazy, like they're like, yeah, we stuck it to Wall Street. And you're like, well, in many ways, actually, it's the short sellers who tend to stick it to Wall Street. And I think we need them. And for all the reasons everyone's just listed, I stopped shorting 5 years ago, maybe, and I don't know why anyone would do it. It's too risky now. And it's actually bad because those are some of our best fraud detectors. Now, I think GameStop, for a lot of reasons, was a terrible short. But there's a place for short sellers, and we've kind of beat them out of the market now. And to the people, who think that they're giving it to Wall Street right now. It's like, yeah, I'm sure Wall Street's really pissed about all the record trading volumes, and I'm sure Wall Street's really pissed that you guys are going to take your proceeds and probably dump them into some SPAC. It's like, no, Wall Street's doing just fine. It's just like we're losing short sellers left and right. I mean, who's going to short after this, right? I mean, it's
well, Wall Street is doing fine, but who knows how this ends up? Like at some point, right? These market makers that are selling all these options are delta hedging. So they own, think about how much Tesla stock is owned by the biggest options market makers, right? Just about that. And those guys are not banks today, but they have massive balance sheets. Like I don't know how, and like, I don't know, I haven't heard anyone explain to me, I haven't seen any papers that explain to me what happens if people go on a buyer strike and literally just, if they dump all their options, like if we go into another panic-induced COVID type thing or trade war type thing, and everyone panic sells their options, they just hit sell on whatever the price is, like who is going to be left to absorb like the selling by the options makers of these deltas into the market? And like, and are some of them going to go under? And are they going to take, if they're counterparties to the banks that are too big to fail, are they going to take the banks down with? I don't know how systemic this is, but it does worry me. I think that there's a lot of leverage in the system that is, I don't know where it's sitting, but like, I don't like when those situations happen because you never know how they're going to end up.
I think we're, I don't know all the answers to this stuff, but I mean, I feel like if you follow most of these transactions, you follow almost any transaction, right? Especially the short-term stuff, it's all kind of a zero-sum game, and then there's someone taking a vig in the end of the day, right? There's some sort of, maybe it's a market maker or whoever. Like, in the end of the day, I don't really, like, just to take the example, shorting, is it simpler, right? Like, I can sell a bunch of stock short, right? And I did a whole bunch of selling. And maybe I've done it at such a volume, I've driven the stock down. And it's different than all the options and delta hedging and such. But like I've driven the stock down. Eventually, I'm gonna have to buy that stock back, right? There's always this equal, like at some point, positions need to be unwound.
You could say the same thing. You could say the same thing about the mortgage-backed securities market in 2008, but it almost took everything down with it.
And yeah, I mean, so I guess there could be systemic risk in there at some point, but mostly I just think that, to me, what's happening with GameStop is that there was probably a technical basis for some of that movement, but then people started writing about it, articles started coming out. I've had like 5 or 6 people in the last 2 days. First, 3 years ago, no one ever asked me about stocks, ever. If they weren't professionally and asked me. Now I'm asked, like, I was at the dentist 2 hours ago before I came here, and like, I was asked about GameStop. Like, there's like, everyone's talking about this now. My wife's sending me articles from New York Times about it. Like everyone's watching it. And the thing is what they do. They, you want to get back to the gamification debate. They open up they're like, oh, they're getting to shorts. This is going to keep going up. And so they all start diving in themselves. They go in a Robinhood app, they buy it. And in the end of the day, it's like, well, whoever got in there first in that trade made a brilliant maneuver. But they needed to, if they build up a big position, they're going to need to dump and sell it, right? This isn't a long-term hold for them. So in a sense, it's almost like the initial movement and the fact that this became such a big PR story has then brought second wave of buyers in, which has allowed the original people who made the trade to now unwind their positions. Yeah. So like, I mean, truly, I think what's happened here is, on one end, we have hedge funds who are frankly irresponsible. Like, you can't leave yourself exposed to this stuff. Like, you can't use leverage. Shorting's the most dangerous form of leverage because it's a variable liability. It's like you can just borrow $1 million. You borrow $1 million, that can become $10 million like that, because it's tied to a stock price. So it's so dangerous. And for people to be doing that and to blow up over that because they didn't have their risk management in there, and they didn't have, like, they were an option edge, and they were doing the stuff that they had to do. And by the way, anyone who's actually ever tried to figure out how to short and do risk management, I think if they follow it to its logical end conclusion, they just say, screw this, I'm never shorting, because risk management it almost like doesn't work when you really delve in deep enough, or you spend so much money doing it. it destroys any alpha you think you were going to create. But like, I just, you know, on one side you had those people, but on the other side we have a bunch of people who can't read a financial statement and have Robinhood accounts, who have, I think that there's a good amount of money that, you know, you throw all their money into one or two stock names, they'll move them.
It's a lot of money. 2 million,
Yeah,
2 million people who throw $1,000. Some people throw 50,000 on Reddit. People throw 500. But like, you have 2 million multiplied by 2 million people. That's enough to move. And especially when you do it in options, which are leverage on, right? It's you lever that up. You could lever it up 2x, 3x, 5x, 10x, 100x, depending on how far out of the money you go.
Right.
You know, you're less likely to get paid out. But like so you see momentum and you lever up, thinking the momentum is going to continue, and it kind of catches on to itself and just keeps going. It's nuts. I mean, there's a lot of buying power. And here's a crazy thing I haven't heard anyone really talk about, but like, you just had, I mean, there's at least half a dozen funds that I've heard of that are billions of dollars that are down 10, 20, 30, 40, 50, 60, 70%. So we're talking like 10, 15, 20 billion dollars of money been transferred away from pensions, endowments, high net worth individuals and these hedge funds that are invested in these hedge funds to these Robinhooders bank accounts, with some toll going to Citadel and Susquehanna along the way. But like, that's a massive transfer of wealth. Like, that might actually be really good for the economy. I don't know. I mean, billions of dollars, like divide that by 2 million people, right? Like, I don't know how much of that went to the market makers. Hopefully not a lot. Hopefully most of it went to those 2 million people. And so like, if you're thinking $20 billion just got divided across 2 million people who were early to the party, that's like life-changing amount of money for many of them.
If they
I think there's several different actors here with varying degrees of either taking money out of the system or losing money, and whether or not they're sympathetic. There's the Reddit traders who kind of, let's start at the beginning. There's the people that put the short position on, who are big boys that did a big boy trade that should know what they're doing and be responsible for the outcome. You've got the initial Reddit traders who kind of yelled fire in the movie theater, and then people ran for the exits. And then you've got more sophisticated people who saw a good trade and hopped on. And then finally, I think you got like in our business, you guys, most of you guys run funds. We run portfolios for mostly high net worth people. We've got people calling us out of the blue, hey, should I buy GameStop? You know, and they don't know anything about delta hedging or Vega or, you know, the Greeks or any of that nonsense. They're looking at this going, this thing just went up. I got to get on board. And, you know, where I sit, those are the people that I think are going to be sympathetic if they lose some money. You know, if you got a a guy that's on Reddit with a Robinhood account, you know, maybe he learns an expensive lesson. Maybe he takes money out of the market. Maybe he doesn't. You know, the big boy that did the big boy trade, the guys that piled on, you know, in some sense, it's just like, that's sort of the risk you sign up for when you short stocks.
Yeah, I think the most irresponsible thing, in my opinion, are people who are sophisticated and wealthy and know better, and who are encouraging people, as of last night and this morning, to buy GameStop, to stick it to the suits, when like they can afford to take that loss. But there were people today in the morning who bought GameStop at $450 a share, thinking like, wow, like so-and-so famous person told me it's going to keep going, and he just told 2 million of his followers that they should all do it, so it's definitely going to keep going. I don't understand what those people are thinking. I mean,
well, so what's interesting is these guys have all now made so much money on GameStop, these Reddit guys, that they now have ammo to go look for like companies and run the same playbook again. And so it's just, you've just created this, I'm going to call it just a shitstorm of activity. And I can see it, like we run a long only portfolio, and I can see in the names that we own, we have one or two that have a decent amount of short interest in them, and like the rest of them, for the most part, don't. And I can see the gross come down, and I can see, like yesterday, there were one or two stocks that we own that were just ripping while everything else was, you know, kind of not doing so well. And I'm like, okay, I now know the ownership base of my companies based on the behavior that I observed yesterday. And, you know, today, as it's backing out, the ones that were ripping yesterday are doing poorly today. And it's just, the whole thing unwound on itself. And it's just like, it's amazing to watch the market sort of just digest this. I don't know if there'll be any changes as a result of it, but it's fascinating to observe.
Well, let's think about some of the implications as a result of all this happening, because then not only just this happening, and then of course this morning where, you know, the new narrative with Robinhood now halting being able to even have take new positions in some of these stocks, and only really being able to sell. I think it was actually not just on Robinhood, but also on TD and a couple other the brokerage firms.
I think all of them right now. I mean, yeah, I tried to sell puts this morning on IB and it wouldn't let me.
Really? Oh my gosh. Yeah. So, I mean, what's really
the activity actually is impacting my business, because the brokers, Schwab, TD, et cetera, like they're jammed with people trying to trade GameStop. I can't get legitimate trades through because, you know, I have to at least plan a little better to get legitimate trades through, because like there's a risk that, you know, they shock the system, and it's super interesting. We haven't had serious issues, but like people can't log onto the website. Like that always makes me nervous. I'm like, I can't check my TD app because too many people are crashing it.
I mean, that's been one of the biggest narratives coming out of this, actually, is this idea of decentralization, you know, where especially if you're some of these, when let's say you're just trying to get out of, let's say, or not get out of, but let's say you're one of those investors that, you know, as Yaron was saying this morning, is like, hey, I want to, you know, this really smart rich person is telling me to go take a position in this. I want to go buy, and they can't. Or, you know, likewise, just being able to get out, it being difficult, or others that have more access are getting out faster than you, you know. So I don't know what you guys think about that, but I mean, you know, Bitcoin has been up a little bit as a result of some of the activities of today. But decentralization has been a hot theme now that's been talked about. I mean, Winklevoss twins kind of, you know, that was a great argument on CNBC this morning with I forgot exactly who, but they were having a back and forth about all that as well, you know. So what do you guys think about that? I mean, is that something that we should be thinking about more seriously, or are there other implications that are a lot more
what's the decentralization in this case? You know, taking out the broker, like I'm in New York, having some guy with a satchel and a bike grab my order and send it to anyone else in town who I sell to directly. You know, I mean, we've got brokers in place here, and the brokers are backed up by the clearing houses as well. And so when you look at there's an issue with all of these online brokers, but if Pershing is clearing them and Pershing refuses to trade certain stocks too, which happens all the time, then, you know, what are you going to do? You've got several layers in there, and those layers are set up for protection because of regulations and SEC rules and things like that. You know, how do you remove all of that in order to kind of give freedom to the people, so to speak, to have direct interactions and sales? I mean, right now, in order to have that direct interaction and sales, if I had GameStop and Kevin wanted to buy it off me and he's unable to do it as broker, you know, I guess there's some way that I could send this electronically to him in an alternative universe. But then if I feel like I got screwed over that transaction, I'm going to want some recourse, right? And if you get away from those levels of infrastructure, you lose that recourse. And that's exactly why those levels of infrastructure were created in the first place. You know, there's this dichotomy, and this goes across all political spectrums of protection and freedom. And the rules generally get written in times of stress like this. And then the political ramification, you know, if you're a libertarian, you know, those free market things go out the window if you got screwed, or if you're, you know, far left or something like that, and you want those protections. Well, now we've got AOC saying we got to like lift these regulations, or lift so Robinhood can be an app for the people, whatever. So the political ramifications and philosophies are gone.
I guess I just wonder how you police this. Like, this is not licensed people. These are not, like, it didn't start with licensed people. I shouldn't say that because we don't know.
Well, it's policed through the brokers. I mean, the SEC and the regulations regulate the clearinghouses and the brokers, and then the brokers are the ones who implement all of these things to the people. I mean, that's why Robinhood is stopping trading, not because they're worried about, you know, all the volatility and stuff like that. Like, they're going to get sued by the SEC. They're going to get sued by, you know, the clearinghouses are not allowing them to trade the stocks and et cetera, or to clear the positions and things like that. So, you know, that's what they're afraid of.
Yeah, but at what point does that kick in? Like, at what point is it too crazy?
Well, clearly now.
Okay, but I mean, like, at what point along the way do you make that determination?
I mean, you don't know, right? It's you can't.
Is
you
it
can't say that
pornography?
2
You know
days
it when you
ago.
see it, and that's what it is. I mean, like, and
I think
like,
there's
if you're,
knee-jerk reactions, actually, when you get right down to it, there always is.
It is. It's always after the fact.
Federal-
you know,
federal-
it is not rules based. It's
Yeah.
results based.
I mean, some of the things that are going to happen is that the SEC is going to apply additional new rules in some fashion. I mean, it could very well be something to the effect of like that they increase or place a significant tax on day trading or on, you know, extreme speed trading, however you want to look at it. And I think there are going to be some outcomes. It's not, I don't think they're there yet, but I think we're going to start hearing about them relatively soon. I mean, to be honest with you, I think we're going to start hearing reactions next week. Again, we've already seen that the lawsuits have already started to come out. Federal lawsuit in New York, as we're talking about, they recently come out about 12 o'clock. There's going to be those reactions that are going to apply. It's going to slow things down, and it's going to give them a little bit of time, the feds, whoever are the authorities, to begin to alter the underlying. I mean, I think Yaron did a great job of being able to isolate what could very well have been an intrinsic problem in the dynamic. Okay, if one guy understands it, the other guy is going to say, "Oh, geez, I didn't know that was going to happen," and all of a sudden they can ferret out what the opportunities are for control. And I think that's what's going to happen. There's going to be some level of control. I think it's going to be knee-jerk reaction to begin with, and then over time it's going to probably prove out to be a little bit better.
and the only thing I can think of that would really be effective is just trying to limit who has access to what type of options trading. But like, in order to get access to options trading, you just all that's required is a certain amount of net worth and experience. So it's like, I'm just like, I struggle to understand how somebody would prevent something like this from really happening again, if outside of making Reddit responsible in some way, which I don't think is going to happen.
I think you're right. I think basically what's going to happen is that the rules are going to be that you have to have $15,000, you know, in available funds to start option trading. That's going to limit the number of people. If indeed, as Yaron was saying, if you give $100 or $200 or $1,000, you know, you can start trading with that. That's one class of trader.
Yeah, but those rules are already in place for day trading. You know, and either they were just not followed by these brokers, or I don't know.
I mean, I remember in 2008, anyone who was asked whether mortgages were a systemic risk said, no, we have decades of history that house prices are uncorrelated and they tend to go up over time, and it's fine to let people do no doc loans with 5% down, and it's not systemic. Like, and it almost took down the entire global financial system. So like, it's not always obvious that something is systemic until after the fact. I still am not confident that if we get a buyer strike of these, if everyone gets super leveraged long with options, that risk is sitting on some market maker's balance sheet because they own the deltas, right? You're putting up 10% down, they're going and spending 90% of the rest to buy. Like, you have the equity and you're borrowing from them, they're going out on your behalf and buying that 90% of the stock as the deltas go up to 1 eventually. They own a lot of freaking stock. And so like, I don't know, maybe the market makers fail, or maybe they don't. And either way, I feel like after we see the next downturn, we'll have a better sense on whether it's systemic or not. But like, I don't think it's like just coincidence. The last few market meltdowns have been straight line downs, right? And that's just on index options, right? That's literally like index option gamma unwind was basically like the gamma associated with these options supports the market until it evaporates. And once it evaporates, the market can just go down very quickly. But that's just index option driven. Like, I don't know what's going to happen to some of these single names. Like, it could be crazy. It could put some market makers out of business. Maybe, maybe not. If it does, it is systemic, and there'll be hearings from Congress, and we'll find out why it was a problem. And if it doesn't, then maybe it'll just keep going on forever, and it's not a problem, and you know, everyone wins somehow.
I mean,
I doubt
if a couple of market makers go out of business, is that a problem? I mean, like Knight went out of business on a trade error. I mean, no big deal.
Yeah, unless they take down the banks with them. I don't know.
So there's been
I have no idea. I'm clueless. I'm just saying it doesn't have to be not systemic. Like it could be systemic and we just don't know it yet. That's what worries me the most.
I mean, what's interesting about this whole thing is because, you know, you guys are making the technical case of like, all right, well, this is actually why Robinhood shut down right now, right? Like you guys have all made it pretty clear as to what's might be happening behind the scenes. But from the public's perspective, you know, it's the simple answer is that, hey, they want to stop you from being able to trade in these names right now. And, you know, this is now a platform that's not, that basically lost all of its brand equity in a matter of less than, I think, 24 hours, which is pretty incredible to see. You know, so, I mean, how does this then change the game for, you know, the individual investor that was buying and selling stocks on this platform when now they're seeing like, hey, they can actually just take over the game for me if at any time it situations like this happen? You know, what do you say to those who say, you know, the power is now back with the individual investor when, like, here you go, the tools to the game can easily be taken away?
Yeah, I don't like when rules to the game get changed like that intra game. It's not fair. Like,
no,
if you bought GameStop at 450 and all of a sudden the rules change and now no one else could buy it from you because they are restricted from buying it at the broker, you literally got left holding the bag because the rules changed after the fact. I don't think that's fair.
Don't the rules change for the hedge funds that are involved in this too? They have to get the gross down. Like, because you got a risk manager tapping you on the shoulder saying, get out. You know, it's over.
But those are the rules when you signed up. If you start losing money when you're leveraged, you have to degross. Those are the rules when you signed up. If you bought GameStop at 450 on no basis other than technicals and people telling you to, and the rules change after such that it's impossible for other people to buy that stock from you, so by definition it has to go down, literally the rule change is what costs you money. Not, in your mind, it's not that you bought GameStop when it was overvalued, it's that the suits came after you because their funds were getting blown up, and that's what they see. And like, it just reinforces this view that they have that the system is rigged against them. And it's, I don't like anytime that gets reinforced, because I don't believe that there's like this system that is all in collusion with one another. I just think like, I don't know, but it is unfair. Like, it does reinforce their belief that the suits are all in this together, and the second one of them starts to lose money, the rules change, and all of a sudden, like, you know, the little man loses again.
If they don't step in and do something, to your point, you're worried about these market makers, and there's no limit to how crazy it can get if in a situation where where an adult doesn't step in, right?
Flag a rule change for 3 months out. Say, here's how we're thinking about this. It's kind of risky. In 3 months going forward.
Or a day. I mean, like, just like, yeah. Coming out and just doing it is somewhat draconian, but like, if they don't step in and do something, like, what's going on is crazy. There's no math. The maths don't apply to crazy. So it could theoretically, like, it could trade like Bitcoin. You know, what's Bitcoin's free cash flow? Well, what's like?
Yeah, I don't know.
In theory, something like that could happen. I'm not saying that it will, but theoretically that's possible unless an adult steps in.
Yeah, there's no law that says things have to trade on fundamentals. If people want to, you know, trade sports, if people want to sell sports teams for 100 million this year and 500 million next year and 3 billion the following year and 10 billion the following year, it's an asset that everyone wants to own, and they're willing to own it. I know that, you know, obviously, like, television rights have really driven sport, but I'm just saying, like, art, like a Picasso painting is a better example, because that doesn't generate cash flow. There's not.
You should have said sports cards. I mean,
sports cards, exactly. So like, why can't Tesla be a collectible that everyone just wants to own? Like, and that's the problem with shorting, is that especially if you're shorting something that becomes a collectible, and then gets magnified with options, like, that's how you get blown up. Things don't have to trade on fundamentals, but like, you also shouldn't change the rules in the middle of the game without letting people know. I don't know. I mean, it's not what you signed up for.
It depends on who owns the responsibility for the outcomes, right? Like, so if you're a broker and if you feel like you've got an obligation to protect your customers, like, I don't know.
Yeah, that's fair. That's a fair counterpoint.
It's times like these where I'm so glad I'm just a little simpleton who doesn't understand what the hell is going on, because I mean, really, it's like, I own some stocks. I don't use leverage because I like the businesses. I think they're going to like compound nicely. They're going to grow their intrinsic value, by which I mean ability to generate, cash flows, not, be at the head of a Ponzi scheme. And, like I don't know. It's real nice to have. My advice to people would be, my advice to people who are watching this is don't buy GameStop or I'm sorry, GameStop, I should say, GameStop stock, and try to simplify things, because you can tell like none of us really know what the hell's going on, and that's the risk.
Yaron sounds pretty smart. I got to tell you, I think he knows.
Yaron knows. I agree, and I agree actually with him about the retroactive rule changing and all that. I totally agree on that, by the way. But it's, the market's obviously starting to act a little crazy right now. And I think to the extent you can mute the words GameStop and focus on your stock picks, that is a good thing, right?
That one too. That's what Elon Musk tweeted out. But Tom, you're so old-fashioned. I mean, come on. We're talking about actual analysis and fundamentals. I mean, I would say you're, it's 1880 or something like that. But I think we're actually in 1880 kind of speculation and the way we trade. So I don't know, maybe you're a 1950s kind of guy or something, and you actually cared about what Ben Graham had to say and you're applying it. So, it's just crazy that these fundamentals, that's not even part of any of the discussion, right? It's crazy. And it's not just with GameStop and a couple of these others. I mean, I won't say it started with Tesla because it started before that, but we get in these manias every once in a while, and here we are. So I'm gonna bounce in a minute here, but I wanted to kind of make the final point from my end is, to the question of who bears responsibility. There's legal responsibility, but then there's kind of that moral responsibility. And when you have a couple figures, famous people online, people who are seen as kind of leaders, so to speak, and they're making comments that are stirring the pot. They're saying these GameStop tweets that come out. Chamath said something the other night, we've got other people online who are billionaires who are feeding the frenzy, right? And they don't have any legal obligation, of course, but the end result is the second and third order effect is, their followers are going to be buying into this. And a lot of them are going to be holding the bag, which seems to be the case now. And so these certain people helped to fan the flames. They didn't create the flame, but they fanned the flames. And now these the retail people, the people that are contacting us who've never invested before, our friends from many years ago that we haven't heard from, and now that we do hear from, they're the ones getting into this stuff, getting screwed. And, the proximate cause is the brokers are not allowing them to, to participate right now. But there is a second proximate cause and a third proximate cause. And it's some of people that they respect fanning the flames. And
well, Steve, real quick counterpoint to that, because Yaron also brought this up as well. But I mean, some of those figures couldn't potentially predict that Robinhood would literally change the game. Maybe they probably could have put out that tweet at 6:28, like saying "go long," and then little did they know at 6:30. Or sorry, this is Pacific.
Yeah, absolutely.
You still have a sense of responsibility. You still have a responsibility. You have 2 million followers, 5 million followers, to not lead people off the edge. You don't know.
Look, let's say Yaron, let's say I was a friend of yours. We haven't talked in several years. I know you're an investor. I reach out to you a few days ago and I say, look, I want to get into the market. This seems exciting. I've got a little bit of money, my life savings here that I've saved up. And if your response is, I'd go long GameStop on options, I'd go long, AMC. If that's your response as a professional, mature individual, if that's your response to me as someone who, expressed that I didn't really know what I was doing, you bear some responsibility for my outcome. I'm the one that made the decision, but you're the one who I look to as someone who knew what they were talking about. And that's where a lot of these followers look at those types of people online.
Yeah, look, I don't think his intentions are bad. I just think you should act more. You should know that if people are looking to you for financial advice, you should like extra caveat, like, hey, this is super risky what I'm doing with my money. I'm not telling you to, if you want to do something like that, but like, I don't know. I see the marketing angle and the fun angle, and it's a game, but like, just constantly remind people then that $1 million for you isn't a lot of money. So when you say you're putting $1 million in, and people decide to go put their entire life savings thinking it's less than what he put in, like, it's not all the same thing. And by the way, like, thinking back to the mortgage analogy, in the housing bubble, what literally what happened was home values just went up and up and up because mortgages were so easy to get, and because so if you put down 10% on a $100,000 house, you put down 10 grand on a $100,000 house, the bank gave you 90 grand. And then the next person came and they were willing to pay 110. You know why? Because like the bank was giving them almost all the money anyway. That 10% increase in the $100,000 house was literally doubled your equity value. And then the next guy came along and bought his house for instead of 110 for 120. He doubled his equity value. And like, if you're putting a small amount of money down, small changes in the asset prices can lead to big moves in your equity value, which is like, that's how the housing crisis did. Easy leverage with appreciating assets, and people getting more and more aggressive with their purchase prices because they think they're going to sell it to the greater fool. But at least with the mortgage crisis, you had 5-year, 10-year, 15-year, 30-year mortgages, and you weren't going to be margin called if the value of your stuff went down too much. There are people here who are doing that same thing, but margining up their account such that brokers literally could just close out their positions at any time if they're not within their margin requirements. And like, the mark-to-market on these options are way lower, and the duration on these options are way lower than 15 years or 30-year mortgage. So like, the risk is even higher, and that's just kind of worries me. Like, if we get to that point where people are just, everyone's playing the greater fool game, and asset prices are bid up and up and up, it's just hard for me to imagine that risk does not sit on someone's balance sheet when asset prices are going higher and higher and higher. And then when those asset prices do eventually come down, if they do, that's deflationary pressure, because there's real wealth destruction. People pull back on consumption, they pull back on spending. And so like, the last thing we need is an asset collapse. I just think it's the worst thing for any long-term investor to want to see that. And so like, on one hand, you're like, let them be, what's wrong with letting them do what they're going to do? It's fun. But on the other hand, I don't think it's long. If you're sitting here and you want to own stocks for the next 30 years, you want stable GDP growth with stable asset price growth over time. I think that's what you want. So I don't know.
Yeah, I agree. And on that note, I need to jump, guys. Thanks for letting me participate. I look forward to next week.
And before he leaves, was I the only one that like didn't recognize Steve the first minute he was on this call with that hat on? He gave an incognito for this discussion.
Well, it's funny because I had to shave the beard because I had an Army Reserve thing the other day that I had to do virtually. My last action. I'm retiring March 1st. I'm a lawyer there. I had a client to represent virtually, so I had to shave the beard for that. And then, I've been so caught up, I guess I haven't showered in several days now. No, I've been running around all day, got to wear the hat. So, but look forward to next time, and Godspeed the rest of this conversation.
Thanks,
Steve. Good luck.
Thanks, Steve. Good luck, man. So, sorry, Siri always pops up every once in a while. Hold on, I did not.
I'm still enjoying my popcorn, by the way.
I can tell. I mean,
this is fascinating. Just to let you know, this is fascinating. Yaron, I think you're quite uniquely disposed to be able to tell us the story. So I appreciate that from your perspective. But I'm still
very much so.
Butter on my popcorn. So I'm with Tom. I'm just sitting back watching.
Do any of you guys actually short stocks these days? I know, Tom, you said you don't. Kevin, you're on.
I do, but I lost money on my high short interest stocks earlier this year. Fortunately, I kind of noticed this trend and covered most of them before last week and all of them this week, like first thing. But it has not been a fun year to be a short seller now.
I noticed this taking place in like a few different like microcap names, and I was like, somebody's got to be clubbing up to get interest in these names or something somewhere. Like, I can't quite for the life of me figure out why certain companies are all of a sudden up 100% on no news on, 3 times their shares out. And like, I've been watching Reddit, as sort of the GameStop stuff is unfold, but I've not been a real Reddit Wall Street Bets follower in any way at all. So like, but I've noticed it's sort of in these I noticed the Tesla phenomenon, which I just thought was more of like a cult stock thing, and maybe some of the option buying just sort of exasperated some of the volatility in it. But it's sort of like, to me, a cult stock. And like you said before, hopes and dreams and all that sort of thing. But like when I started seeing it pop up in sort of these sort of low float, sort of should be short. Should be shorted because they could be terminal microcap stocks for no reason. It was just sort of fascinating. And so I started actually putting together lists of companies that I thought like, well, maybe something could happen here. And it's been, I don't short stocks. This is one of many reasons I stopped shorting stocks. But
yeah, look, I don't run with like a ton of gross leverage, right? I tend to buy stocks with less than 100% of my fund's capital on the long side, and then I short single name stocks that I think are going to go down over time. But I don't have a mandate that I have to be short anything. I'm happy to cover those shorts. I'm happy to use index. I'm happy not to be short at all. I think you're in a tough spot if your mandate is to run 300 long by 300 short and be market neutral. Like, you might see this working against you, but what do you do? Like, you have to be short names. I guess you could just take your book to zero and say, hey, firm, I don't want this capital right now. Like, could I still keep my job for when I want it back? But like, it's just not your mandate. I don't know. You're in a tough spot.
I mean, another aspect of this from a mechanical perspective is you have to locate the shares to borrow if you're going to short the stock, right? And so when you get a fever of activity like this, couldn't your locate just disappear and then you also have to buy it in? So you've located somebody's shares that you're.
I think it's very rare for borrow to be pulled. What could happen is your cost of borrowing the stock could go up, and that just kind of makes you want to cover it, right? If your cost to be short is 50% annualized or 100% annualized, I think that's what kind of makes you reevaluate. But I think it's very rare. I mean, for
in an environment like this, your locate could just disappear.
It could. Right? Well, I think what has to happen is in a
normal environment, your locate is probably pretty good.
Well, the only thing that would make the locate disappear is if the stock is held by a very concentrated group of investors, and those people who own the stock call their prime brokers and say, hey, I don't want to lend out my shares anymore. That's how a broker will never just pull your shares to lend it to another hedge fund. I think that's very rare. I've never heard of that happening. I think a broker will say, hey, those shares got recalled because the owners don't want to lend them out anymore, so we literally can't lend them to you. I think that's how you could get bought in. But like, I've never heard of someone just saying, hey, like, this hedge fund is more important than you. And maybe it happens. I think it's
no. What I'm saying is, okay, I've got 100 shares of GameStop. Full disclosure, I have no position in GameStop. I've never had.
Right.
You want to short GameStop, you borrow my shares and short it at $5-6, right? Whatever it is. It goes to 20, and I say, holy cow, I'm out. And I sell the shares. What happened to your locate?
Yeah, it's a good question. I guess the person who buys them, if they lend them out, I guess, it's a good question. I don't know.
You got to have margin on the account in order for them to do that. And not every buyer has margin on the account.
Right.
I mean, I just think there's so many mechanical aspects to what we just witnessed in a variety of, like, it was like it's a perfect storm of bad for people on the short side.
Yep.
I mean, that's what's so hard about this whole situation, and why I wanted to talk about this for this roundtable today is because there's so much technical side of this that is getting simplified to the nth degree because of the nature of social media, the nature of Twitter, and people trying to explain things in a much simpler way for those who have no idea what options or shorting is in any respect. But the thing that, Gary, you brought up earlier that I thought was really interesting, and this is something that I kind of talked about when I was on Fox Business with Charles Payne, was this idea was that That was, by the way, that was the most amazing experience. I loved it. I was being, little showboat, right? But what was cool, what was interesting about that whole
The
thing
head
was
just grew about 3 inches, by the way.
you saw that, right?
Yeah.
Okay. So
You looked amazing. That's it needs to be said.
Thank you.
Yeah.
But but what was interesting about the question about why are microcaps surging is because with this kind of and I don't like calling retail investors retail. I like they're individual investors, right? These are individual investors because retail has that connotation of not sophisticated. But I think a lot of these individual investors are very sophisticated and know exactly what they're doing. And what's interesting is maybe not necessarily doing the same playbook of looking for company, especially microcaps that have high short interest in them, but just finding names that hit certain trends and just guiding the armies. That's what happened in 2020 with a lot of these microcap names that are now trading at these multiples and valuations that we would all agree are, whoa. That's my best description of it. That trend could easily keep continuing no matter what the macroeconomic what happens from a macro perspective. What do you guys think? That it's very simple to continue to keep driving that towards each new individual name. This is nothing new. This is something that a lot of these trading companies or individuals that now have trading academies, they've been doing this for years. It's just now very much front and center in public because of the nature of social media. So I just went on a whole diatribe. So anybody want to comment and tell me I'm wrong on anything that I just said? Please.
I'm not going to tell you that you're wrong, but was there a question in there?
I thought there was, but I guess it just turned into a comment.
Oh, it was a rant. Yeah.
I got a question.
I guess it turned it. I thought it was going to be a question that ended up just being a rant.
I think he was trying to bait one of us into going after individual or retail investors, and I'm happy to take that bait. So if that's what we're doing here.
I didn't put the bait. I'm just whatever. I have a comment. How about that?
Okay.
I basically think that we're basically back in the late 90s, but with smartphones and better user interface. You go back and you reread articles from the late 90s. I was still in high school. I wasn't really investing back then, but I can obviously read a history book and talk to people who were there, and it seems like there's a lot of people who are not professional, who are currently getting very easy access in the market. They're not trading across a wide variety of names. For the most part, they're trading in and out of, the same sort of names, and they're getting positive feedback right now, which is that it's working short term. It worked short term in 1998 and 99. And then, a lot of them lost 90-some% in 2000. And it's, to me, I get it comes off condescending, but I kind of don't care, because here's the thing: if you haven't put your 10,000 hours into something and you're going to step on the field and get in the game and compete with a bunch of professionals who have put in their 10,000 hours, you're delusional if you think that the odds are this is going to work out well for you. There are a small minority that will. There are lots of people who do well short term. It's like someone going in. You can go into a poker table and play with a bunch of top-notch poker players. If you play for an hour or two, you can win, and you can make all the wrong strategic moves and you can win. I guarantee you, if you spend enough time with those guys, you're going to leave penniless. Because you're not making you don't have the right process. You're not making the right decisions. And in the end of the day, don't get me wrong. I'm happy to see a lot of new investors coming in. I think some of them are going to become great investors one day. But here's a really simple question you have to ask yourself if you're currently diving into investing here. Can you read a financial statement? If the answer is no, you're not an investor. You're betting on red and black. The house is going to win if you stick around long enough. So
Lee Cooperman was making that very same point on CNBC of just let's distinguish between, investors and speculators,
And by the way, there's, with the right risk management approach and philosophy, you don't need to be able to read a financial statement. You just need to know what your game is, and know how to play it and know how to manage your risk. Like,
Agreed.
if you're a chart reader and you're not managing billions and billions of dollars, you're managing your own wealth, and your game is to read charts, know where you're getting out, know how much you're willing to lose, and know how much things could gap on you, right? Like, even if you think like you have your stop losses in place, but you put 100% of your net worth into one trade, like there could be a press release, there could be something, right? Like, you read situations where like the Volmageddon that happened in February of 2018, like things could move. Yeah, things could move 20, 30, 50%, 200% overnight against you. So don't use leverage. Don't put all your eggs in one basket. Know where you're going to get out. Have a good risk management, philosophy, and everyone could use a little bit of good luck,
There's some fascinating stuff there, because one of the things that I've been trying to do is collect information by using polls and what people are doing. And one of the things that's really quite interesting is the idea of money management, being able to exit these stocks and the like. And one of the ones that really amazed me, two of the ones that really amazed me was, do you have a system that you use, that you follow on a consistent basis to be able to make money? And the answer was 25% of people have systems, have plans. It was shocking. The other one was, how do you exit? Do you exit based upon, you see a top, you have a stop, you gut feel it, or whatever pleases me? And the answer was whatever pleases me. And so what I'm finding out, and these are small number of polls, but I think they're still representative, is that what it comes down to is that most people out there who have no system and no plan, and they don't know how to get out of it, and they're just winging it along the way. And that's the part that fascinates me. And I think that one of the things that when I'm twitting these days, I try to educate. I mean, really, as I was saying, is that they ask me, what are you doing? I said, I'm eating my popcorn. Literally, that's what I put out this morning. I'm eating my popcorn, putting my feet up and watching the show. I'm not even gonna go near it, okay? Simply because of the fact that I think that's the best advice to people who make up the majority of who's reading out there. I mean, I think that there are a number of people who are new to the game, as Tom was saying, and might get fleeced, whatever, okay? I think that as a responsible member of some society, you have a moral responsibility if you're going to be out there, talking about what you're doing and all that stuff. I know, for example, that if I wanted to, I could go out there and pump and push and do everything I can to take whoever followers I have, sit down and say, this is the best damn stock, get on board, and yep, it's going to the moon, right? That's irresponsible. So again, I think that there is responsibility at some level, again, whether or not it's at the high technical level, as you describe your own, or whether it's just simple talking to people on a normal basis. Again, Steve was saying, somebody calls me up, should I be investing? The answer should be no. I mean, it should be as simple as that. I mean, good God, no, you're an idiot. Okay. So I think that there are situations where the guy who spent the 10,000 hours has seen it 4 or 5 times already. I mean, I might have seen it a little bit more than others, but it's always out there, and it's so classic. You know when you're going to lose. I mean, I'm pretty much in cash these days. To be honest,
it's so interesting because Steve mentioned this earlier about now politicians starting to get involved in this conversation and saying, how dare Robinhood shut this down? How could they change the game like this? And it's not just on the left. This is both sides are saying this. I mean, I think I saw a Dave Portnoy tweet where he's like, when in the world will you ever see AOC and Donald Trump Jr. actually agree on the same thing? Like, so there, but at the same time, I actually had to ask the question too of like, well, let's say they didn't do that. Let's say they kept it open and whatever happened from there, but at some point there's going to be people left holding the bag. And then then the conversation on the Hill is going to say, well, what, how could this have happened? We got to put regulation in place in order for that to not happen. I mean, it just reminds me of the crypto craze at the end of 2017, 2018, when that happened. There was no regulation that ended up happening from there. Correct me if I'm wrong. I don't think there was. So it's an interesting conversation from there. It's like, well, let these lessons be learned, but at the same time, like, was this the move? And I would argue that I'm on the stance of that they shouldn't have shut it down. I don't think that was a good idea in any respect.
I don't know what the right move is. I know you can't let it keep going on indefinitely, or you could, but I just think it increases the odds that it turns into a systemic issue and leaves people holding the bag. but I also don't like the way they stopped it. So I don't have.
Yeah.
It's unfair of me to say I don't like the way they stopped it, but I can't propose another solution. But
Yeah.
I don't know. I'm speaking out of both sides of my mouth.
I think there are going to be similar solutions, basically not being able to trade. One of the things I propose is that they're going to do things such as slow it down, an entire day of halting, not halting for 22 minutes or 12 minutes or whatever it is. I think they may actually end up halting the whole thing for a day.
No, but they halt the whole thing for a day. It just brings more attention to it, and then everyone's sitting there, rabid, drooling, foaming from the mouth, waiting for the market to reopen so they could all bid it up to the next level.
Hold the line. I mean, like that's
hold
like
hold the line.
Yeah, like,
Have you been every time? My God, the number of tweets. Hold the line. It's as I said. It sounds like Percival on Ready Player One. That's. I mean, in my mind, that's what I actually see is the virtuals having a battle over at Anorak. Crazy stuff.
I mean, well, the other question it comes back to is like, the lawsuit that you brought up, Kevin, that is, yeah. I looked it up. That's the class action lawsuit that's now being levered against Robinhood. But at the end of the day, I thought Dave Portnoy actually put up, I mean, I've been like, he's been on fire today, by the way. I'm a huge fan. I love following stuff too, but I think he actually had a really good point when he said, the concept that Robinhood did this willingly and would willingly implode their own company is crazy talk. Somebody made them. Connecting the dots seemed pretty straightforward. That's a quote of a tweet that he just put out about 8 minutes ago, and it's pretty interesting where like someone directed them to do that. They're now going to have a class action lawsuit against them, but you don't think that somebody called them up from the federal government and said, hey, look, you got to stop this shit. Okay. Or otherwise we're going to put a lawsuit on you. It could have happened yesterday. It could happen 2 days ago. This whole behind the scenes thing is always there. I mean, you can always sense it. There's Fed I don't know what the anxiety that exists in doing this stuff. But that I guarantee you that the guys who run Robinhood did get a phone call. They were advised that they're going to for sure,
and everything's coming down. And that's one of the reasons why they had to begin to make some of these hard choices. That's my opinion. We have to make okay, fine, okay, well, okay. What we will do is we'll stop selling the stuff. Okay, first step. Okay, that's going to be to me in the lawsuit. We did what we could do. We actually stopped selling. Okay. So there's going to be this aiding and abetting thing, as far as I'm concerned. Okay, it's one of those things.
But how do they recover from this now? I mean, look, you go on the App Store. Yeah, they go on the App Store. Robinhood's now 1.1 stars.
It goes back to what Yaron said: is that are you going to believe anybody anymore? They just shut me down. Are they going to do that again? Are you kidding me? They can actually stop me from trading. I mean,
they're done.
That's the first thing.
Arguably done.
In a product, it's no, you can't use my product. What are you kidding me? I mean, that's really what people should start thinking seriously about whether or not they're actually being protected.
I don't know that they're done. I mean, I think that's unfair. I think that they've trained their customers to get dopamine hits from placing trades through their app, and I can't see how that's done. They may be pissed off, but like the other brokers also shut this down. So
I know that's the funny part. I was just gonna bring that up too. Like, it's not like the other ones didn't shut this down. It's just Robinhood's taking the brunt of the blame and
but Robinhood is not part of the establishment yet. I mean, E-Trade, Schwab, TD, they're part of the establishment. Okay, they will kind of go with the flow and all that stuff. But the new boy on the block can very well be taken down pretty seriously. I mean, they haven't paid their dues yet. They haven't paid their 10,000 hours.
So I will say that I do view Robinhood in particular as responsible for this in a tangential way, and that is in eliminating the commissions that come with stock trading. Has made it possible for people to churn their own accounts really fast and do stuff like this. And all the other brokers, not all the other brokers, but the other major discount brokers followed suit. And so it really did remove the friction that did kickstart gamifying this whole thing somewhat. And, quite frankly, I would prefer to get better execution and pay $10 for a trade. If I'm given the choice, but that's not how these people who churn their own accounts think. And so, if they've got a couple $100 in an account and they're doing 50 trades, well, poof, there it goes, right?
So let me ask you the question about quants and algos. I mean, isn't that a part of it as well? What I was thinking about, you just mentioned about the idea of the short money, meaning no money for trades, but the same thing is happening with trades that the spreads used to be, an eighth or whatever it is. Now a spread is a penny, but the algos are making it on tenths of a penny. So aren't the algos also a part of the problem in the broader sense? Aren't they also forcing some sort of dynamic into the market that might not have been there before? I mean, again, this is multi-year, not over the last couple of years.
There's a certain essence where you can sort of, point to the chart where the algo got involved, right? You can sort of see that some days, but I'm not sure. I'm not sure if that's better or worse or otherwise.
It's just another way.
Yeah, we've spent all this time removing frictions in the market and doing all this other stuff. And if you're doing fundamental long-term investing, like a little bit of friction is kind of like, it doesn't matter, but like for some of these things, they're critical for the gamification that's gone on.
So
I think it's almost healthier to have more short-term volatility and less liquidity, so that people know what they own and are forced to do the work. And I personally think it would be healthier, right? If you're going to buy a business and it's private, but it's not publicly traded, you do a lot more work on it than a lot of people do when they buy public securities. And I'm not saying there's no added benefit to being public. I do think it lowers your cost of equity potentially, broadens your investor base. I get that. But like, if stocks were a little bit less liquid, I don't think that the illiquidity premium, the illiquidity like risk premium, I don't think would be so big, because where else are people going to put their money? If you're a long-term investor, if you really have cash that you need to invest for the long term, like if that's your only option, you're going to accept the same return profile of Microsoft, even if it's a little bit less liquid. And we shouldn't use Microsoft because that's always going to be liquid in my opinion. But like, fine, smaller companies, like people will still be attracted to them if they have good growth profiles and they're profitable businesses. But so if there's less perceived liquidity, I just think that people will be forced to do more work. So like, I would be perfectly fine with the quants and algos who provide this added perceived like stopgap liquidity while you're trying to buy or sell something until a new buyer or seller steps up. If the bid asks were wider, things were a little bit more volatile. But this is how the system is. So everyone just has to invest the way the rules are today. And I'm sure there are definitely downsides to what I just suggested, by the way. And I haven't fully thought them all through, but like, I think those are the positives, is that people would have to do more work.
The interesting thing is, I read a PR about 3 days ago. I don't know the name of the fund. It's a fund, a hedge fund or whatever, where their entire operation is to buy stocks and trade stocks using their algo. They put out a piece of news that basically said, well, we're kind of considering adding in real people in support of the algo activity that we're having. And that to me was rather revealing, because it probably suggested that their algos probably began to suck, okay? And that the only way they can get out of it is to get back into real people. So that was really a kind of I didn't know how to read it, but it was fascinating to me that they're going to replace their algos with people. So there's some other weird stuff that's going on in there that may or may not be working for some investors who are, program investors. Pretty interesting though.
All right. Well, I think we've really dove pretty deep on everything that's happened. Is there anything that we missed with regard to what's been going on these last couple of weeks with GameStop and AMC and some of these other names that and the playbook and all of it? Because and actually, here's the real question: in your opinion, do you think the game is now going to be changed in some respect, whether it's from regulation or just in general? Like, has the game fundamentally been changed now as a result of what's happened here at the beginning of 2021?
Are you asking if it will be changed or if it has changed?
Has changed. Actually, how about both? Has, and if not, will it be?
Well, the game has changed, as we already noticed, that Yaron hit it on the head, that there was a fundamental shift in the way in which the dynamic was operating. So that's already begun, so that the shift has occurred. I think that, in my opinion, will it basically be controlled or contained or somehow put under cover? I think, yes, the answer is going to be that, because it's just too much of a disruption. Now, as I said, it might be a knee-jerk reaction brought to bear by, again, people who are less familiar with the nature of it. But I do think that's been changed, and it's going to be counter change. There's going to be counter actions, whatever they are. I expect there to be counter actions.
I don't know. I don't know what the actions are going to be. I mean, I know that there's going to be some class action lawsuits and whatever. And I just sort of wonder if at the end of that, the only one who makes money are the attorneys, like basically any other class action. Yaron had a very detailed explanation of the mechanics of this, and I think I understand what happened. I don't know that it's significant enough in the to really result in any dramatic change. Like it's eye-popping, and it's like a kind of a interesting show to watch, but like as far as I can tell, nothing systemic in nature's happened. You have sort of a change in who caused some of this stuff, but how do you police that? How do you police a bunch of retail people on the internet? I don't know. It's kind of hard. I'm not sure how you effectively do it.
Well, it seems like Pandora's box has been opened, right? Like, we've had exposure to being able to open an account for free and trade for free. So you're telling me now I can't do that? Well, screw off. I'll go trade something else.
Look, like it's a free country and everyone's allowed to drive, but you have to pass a test and prove that you know how to, for the safety of yourself and everyone else. Like maybe that's the answer. Maybe if you want to trade options, you have to pass a test that shows that you understand the risks of what you're doing. I don't know what the answer is. I'm just saying you can't take this liberty away from people. I mean, we do it. You're not allowed to do heroin. You're not allowed to drive. You're not allowed to buy a bazooka to keep in your house. Like there are rules. And so if it turns out that the way this options thing is impacting capital markets is a negative impact on society, then like rules should be put in place. I just think.
Yeah, but to get options approval on account now, you have to fill out, basically whatever the options application is, and the options principal approves you, and you can say whatever the heck say whatever the heck they want on that.
Yeah, but to get a driver's license, you just don't have to answer it. Do you know how to drive? Check yes. I've driven for 10 years. I know how to drive.
Yeah.
You have to prove it. So maybe here's a startup idea for someone who's looking for a startup idea. Start a piece of software that tests people, like 10, 15, 20, 30 questions, half an hour test to show that they know the risks they're taking by trading options. Go sell it to all the brokerages on a per user basis. Everyone that signs up, you get $1.99. They take the test. SaaS margin, high growth. You trade at 100 times revenue. You take this thing public, and then you invest your money in one main capital when you're done.
I'm in.
All right.
I'm in. Sign me up. Done and done.
I have nothing of value to add to almost any of that. I think that I don't think things have changed all that much. I don't think they ever will. I think that if there's money to be made in the markets doing something, by the market makers, by the people in Wall Street, all that, I don't think it's ever really going away. So to be honest, I haven't even followed the Robinhood news in the last day nearly enough. So I've been sitting here quietly scratching my head going, oh man, what happened to Robinhood? Like this whole time. So, but it's, obviously, when you run an app with scratch off lotto tickets to win a stock and you have a little confetti pop when people buy a stock, at some point, I guess someone gives you crap on it. The idea that the genie's going back in a bottle, that we're not going to have people trading stocks for free over their phones, that, people who don't know how to trade options are going to get access to trade options. I don't see any of that changing. And I think the reason we're noticing it so much right now is because we're in one of those unique moments in the market where a lot of people have made a lot of money in recent years, and everyone's noticed and they want a piece of it too. And everyone's going to jump in until until it pops. And I think we all think that it could be, we'll figure out who was swimming naked when it pops. Until then, it's all speculation, but
All right, guys, I got to run. It was a pleasure. Good speaking with everyone.
Ron, great to have you, man. Thank you.
Thank you.
Actually, I was gonna say with that, I think we're pretty much there. By the way, Gary sent a really funny tweet in the comments from Patrick O'Shaughnessy, where he posted a plane just flew down South Beach with the message, and I quote, "Buy GameStop WSB," end quote, trailing behind it. That was a tweet. It's pretty funny.
bubble alert. There you go.
All right.
Actually, that's one of my favorite tweets. Actually, is when people are like they say a situation and then it's like I can't think of an example off the top of my head, but then they say like ... top. Like
we were passing one around here internally earlier today that we just couldn't stop laughing at. I'm gonna get it wrong, but hold on, I'll pull it up so I don't get it wrong. It's
while Gary gets it up,
me talking to my grandkids. We were at the brink of civil war, then we just started buying GameStop.
I saw that.
And I just something about it. I just couldn't stop laughing.
Yeah. No, FinTwit's been just on fire for the last I love FinTwit just in general, but like the last couple of days, it's just been comedy gold. I mean, it's just gold. But with that, look, my final take at the end of the day, for those who are watching this that are participating in any way, shape, or form, just please do your due diligence, know the platforms you're using, and really, I hope from this experience on the winning side or the losing side that you develop a strategy as a result. Because when it comes to investing, and especially in microcaps, it's a great place to build wealth. Just please do your due diligence and please just be careful. Know the platforms you're using, no option, just know the game you're playing, just make money, but try and learn from your mistakes and also from your wins.
And don't lose money.
Do your best not to lose money. That's also, don't get left holding the bag. Whatever, at the end of the day, don't get left holding the bag. Don't be that guy or person.
Don't be that guy.
GameStop?
What?
Is that a call to sell GameStop?
That was not, and I would never ever go there. Just don't be left holding the bag. That's all I'm going to say. Yep. But with that, Tom, Kevin, Gary, everybody, give where people can go and find more information about you real quick, and then we'll get out of here. So, Tom, where can people go and find more information?
Tom Bachrach here. So PFH, P as in Paul, F as in Frank, H as in Henry, cap.com. I even have a little page there dedicated to what I think beginners, investors, books and things and resources that they should follow and learn. It's you either do that or you just buy GameStop, whichever's easier. And then Twitter on PFH Capital with the ampersand in front. So come out and find me.
Very cool, Kevin.
Yeah, I used to be. Am I?
No, you're good.
I used to be at the Good Prick, but now I've changed that to buy GameStop.
You can't give up the handle. You should have consulted
never mind
me.
then. I just changed it back. So never mind.
I'm on my safe filter is always filtered out your tweets, so maybe I'll see them now.
Yeah, you don't want to be listening to anybody who's a prick.
Oh yeah, the Good Prick.
Sorry. Yeah.
Good stuff, Gary. And where can people go and follow you?
I have a website for my RIA. We have a blog on there. It's accretivewealthpartners.com. We have a podcast, my partner Eric and I, with producer Bobby. And that's it for the most part.
Very cool. He has a Twitter account, but until I get the approval to say it, then I will say it. But I'm not going to say it.
It's more of a lurking account than anything.
Very, very true. All right, guys, this was a lot of fun. Thank you so much for doing this, and till next time, till the next thing
blows up.
Yeah.
Take
Talk to you
care.
guys soon. All right. Bye.
You fellas.